Okay, after private equity, we are now moving into private debt, and we've already heard it. Apparently, great times ahead for private debt, but Francesca will find that out with her most senior panel. So, have a great discussion.
Hi. Shall we start very quickly by introducing our panelists? So maybe we should start with Thor over there.
Hello, my name is Thor. I work for Guard. It's the world's largest marine insurance company, and we invest in private debt. So I sit as, I guess, from the investor's perspective.
Richard Dallot from Ciparex. Ciparex is a French GP managing 3.2 billion euros in various strategies, and I'm in charge of sponsorless mezzanine activity.
Greg Raz, hope all are well. Co-founder of MGG, US-focused, non-sponsor lender and structured solutions provider, 4 billion of AUM.
Good morning. I'm Frederic Nadal. I'm founder of MV Credit 22 years ago already. And we've been focusing on private debt since then, doing subordinated senior CLOs and hybrid debt in Europe and exclusively sponsored.
Thank you very much. So we've seen that private debt in general has grown first 10 years ago with a great financial crisis, and the pandemic gave it another amazing boost. Now we're having a little bit of economic issues with a high inflationary environment, interest rates that are growing. So is it again a great moment for private debt? And I would like you guys to give me a bit of your view from your own personal experience, and especially from the mid-market that you all very good at. So shall we maybe start with Greg?
Sure. Generally, speaking at least for the US, the worse the world gets, the better and the more opportunities for direct lenders. It's really been a 30-year decline in the presence of banks in the middle market. Now 85% of loans in the US to mid-market companies are non-banks, but big picture, turbulent times, harder to issue equity publicly if you're a company. You don't want to issue a down round. If 6 months ago someone told you were worth $1 billion, it's really hard for a founder to then issue equity telling themselves they're only worth 700 million. And the banks have largely exited. High yield, broadly syndicated markets are much tighter. So all of that translates into more opportunities, more need from companies to go to folks like us. And that was true in 2009, it was true in 2020, and it's been true since the invasion of Ukraine this year.
Presumably, Gregory, do you speak from a more of a transatlantic viewpoint, or
mostly just U.S.?
Right. So I guess maybe in Europe we have banks are still kind of still have a heartbeat. So Richard, maybe would you like to say something if you have about are you still competing with the banks, or have you not seen them at all?
In fact, in the mezzanine space, because we're working in the mezzanine space, we're not competing against banks. We're cooperating with banks, because we jump in the game when the senior debt capacity of the companies is fully utilized, whether it is through banks or through funds. So we still see the banks, but in the small and lower mid-market, I would say, they have followed the US pattern and exit the mid-cap and large market. So we still see banks in this market. We're cooperating. A common feature with the activity of Greg is that both of us are doing non-sponsored deals as opposed to PE-sponsored deals. That means that we we're backing entrepreneurs that do not wish to dilute their ownership nor liquidate their ownership, because they deeply believe in the upside. And as Greg said, in these market conditions, when valuations may drop because there's a lot of risk and uncertainties, the mezzanine solution appeared to be an attractive answer for those entrepreneurs and business owners.
Thank you. Frédéric, would you like to tell us the same thing from a sponsored deal point of view?
Your mic, yeah. So obviously to the question, I'm not going to say no. Yes, it is a good time to invest in private debt. It happens that we just do that, and it's the right time, and for several reasons. Is that like any crisis, recession, temporary or longer, it's going to accelerate that trend where we're lagging behind the US for a number of institutional investors, and banks are still active to a certain extent, but it's a one-way street. Banks are, balance sheets are shrinking. There's more regulatory burden, and therefore we are following what's happening in the US, and there's still 10% differential between the number of loans arranged by banks versus private provider of debt. So that's one. I think it's going to accelerate this trend, which means that with all the money that's been raised for private debt, there's going to be enough space for a lot of people. The second aspect is that it's the right time to invest because it's an uncertain time, and you start seeing two things. You start seeing companies that have been swimming naked for the last 15 years, and you start seeing investors that have been swimming naked for the last 15 years, that haven't known the Great Recessions, that haven't been through, which was one of the hardest time of my professional life, which was between 08 and 10. And we are now fundamentally going to be able to analyze what's in the portfolios. And I'm looking at you as an investor. For good and bad, it's going to be an interesting time because you're going to be able to see, again, now everyone's doing healthcare, everyone's doing software, everyone's doing business servicing, everyone's doing resilient companies. But that's not what has happened for the last 10, 12 years. People still live with portfolios. So it's definitely the right time to pick the right manager. And first, like us, when we look at companies, how did you do, guys, in 2009? What has happened to you over the last 3 years with COVID, with inflationary environment? And that's on the company side. On the private equity side, on the private side, you can look at what's in the portfolios. And that's going to be the interesting thing to look at from an investor's perspective.
Hi. 3 private debt GPs agree that it's a good time to invest in private debt. It's awesome. But it is. So, very unexpected. In terms from the investor side, the thing is that is it a good time? The short answer is yes, because every time is really a good time to think about it, because when you invest in private debt, it takes a long time before you're fully invested. So you're actually investing now. If you decide not to invest today, you actually basically going to take you 18 months probably before you're fully invested, which means that you're kind of investing for the environment 18 months ahead rather than today. But then again, I mean, I think that interest rates can change everything, right? If we now go back to a world where interest rates are higher for longer, which everyone seems to agree, nobody wants to get there, but if that's the case, then I think the case for private debt is still strong, because what you're buying or what you're investing in is selective deals, is credit work, it's good credit analysis. There's no such thing as an average credit manager. They're all good, apparently. But the trade-off between that and public credit, right, that's a choice an investor has to make. So that choice is, I think, is easier at 0% interest rate than is at, say, 5%. Like, if you're a dollar-based investor, you can buy AAA-rated CLOs now for 5.5% yield, which is, given how they're treated in Solvency II, versus private debt, which is treated as a high yield, it's a consideration. But I think that the short answer is that going into a very uncertain world, because I think nobody really knows where we're going next. So if your aim is to diversify your portfolio, then private debt belongs in that portfolio, in your credit portfolio.
Are we not a bit in a standstill where the private debt kind of replaced other means like the banks, but now we're arriving in front of the hard problems, the hard issues? Are you going to withdraw as well, or are we going to face a standstill where you also going to increase your margins, the debt funds, and the sponsors will think, or the companies in the sponsor-less situation will be, you're too expensive, you're too risk adverse, and a standstill basically.
There is always an intermediate period where there's the bid and ask is too wide for anything to happen. And it is true for private equity in terms of valuation, expectation probably. People don't know where they are with public valuation so low. And it has consequences on the private debt too, is that we are going to try to get better terms, higher pricing, lower leverage, better legal terms and conditions, generally speaking. And it might, you're absolutely right, it might for a certain amount of time freeze things. But at the same time, I think private equity sponsors are driven by giving the money back to their investors, their own investors, which themselves expect liquidity in uncertain time. It's good to provide liquidity. And also they've raised additional money. So there has to be a cycle, and yes, it has slowed down M&A activity, generally speaking. But at the same time, for private debt, we'll face a wave of refinancing and amend and extend, all those things. So from our perspective, I don't think that's going to slow down the activity.
So has private debt now seen the full cycle finally? Because we keep saying that private debt never really faced a full cycle. Is it now?
Well, I would say this is actually probably going to be the first true test in a while, because 2009 and even 2020 were accompanied with lower descending rates, big Q of E, big bailouts. All three of those things are going in the opposite direction. So I think you will see more volatility and beta among private credit managers. Now, it may take 2 years from today for investors really to grade private managers, but I do think the folks who've been more conservative over the last 3, 4, 5 years will actually be able to differentiate themselves in a good way finally, whereas really for a long time it was hard.
Richard?
Yes, definitely. I think that anyhow we will have challenging times ahead. Basically, what we all, the three of us, are doing is that we're investing with a lot of protections, with covenants, restrictive covenants, with a significant equity buffer. This is what makes private debt attractive. But all this is useful to manage risk. But there is risk and uncertainty. And we are living in uncertain times. I mean, risk is something that you can foresee, you can plan, you can measure, put a likelihood on it. Uncertainty is something that takes us by surprise. COVID was an uncertainty. So I think that we will have challenging times, and it might be the case that the answer is not only in the structuring of the debt, but maybe in helping and supporting the companies. At CPRX, this is what we're doing. We have an operating team, digital transformation, cost optimization, and so on. And what we're basically doing is expanding the scope of options of the companies that we are backing to make those companies more flexible. So that's the way to manage uncertainty, i.e. to manage something that we know nothing about. Let me take a very simple example. We invested 3 years ago in a company doing 100 or 95% of its revenues through the physical channel. We opened the window for a digital transformation. There was no need, no urgent matter. The company has been growing for the last 10, 15 years. And opening this option turned to be a success because when the COVID crisis arrived, and this is an uncertainty, something that took us by surprise, the company was able to continue to sell. So that's what we're doing, not only providing capital, providing money, but also providing support and helping the companies expanding the scope of their options.
Well, presumably, in a sponsor-led situation, you kind of be a bit like a sponsor, basically.
You're right.
Thor, do you think we're facing the true test now?
Well, I kind of agree with Greg. This is the first time, right? Like, it's completely different than 09. 09 was a liquidity crisis. They know how to solve that, right? That's why we don't have chances of a bank crisis. We might end up with nationalized banks if everyone goes to shit. But in terms of that level, in terms of liquidity market, if they need to, they can fix it. They know how to do it. They just print. But it's the same thing as any. So in that sense, private debt has kind of been on a gentle curve for the last 10 years. So the environment going forward, one expects to be, that's when we're going to see who is good and who is not, and who can manage risk in their portfolio or not. Right? Of course, problem is it takes a bit of time. It takes 2-3 years, right? And then the investment period, and then that blew up, and then work out the next 2 years. So it might take 5 years before we actually see who is consistently good in making money and making good decisions in the portfolio. But private debt is, if nothing, a long-term game.
Yes. You all work more or less in mid-market. I was wondering, what do you think your advantage point is compared to bigger deals? Come on, Frédéric.
I'm the one probably representing the mid and upper mid-market, actually. So for us, always been the case of trying to invest in diversified companies that are large enough not to have to sustain a crisis in a specific country. So, for instance, in France, there's been the yellow vest and disrupted the economy for a certain amount of time. We didn't want to be dependent upon that. Then you had the Brexit that is still affecting the UK, and for a long time we didn't want to be depending on that. Tomorrow it might be Germany or Italy, etc., etc. So what we try to do really is the virtue of diversification of your portfolio, but also the companies in which we invest, to have multi-products, multi-countries. So I'm not going to pitch you that small is beautiful. I'm going to pitch you that medium is beautiful because of the virtue of diversification. And I think right now there's no decoupling of what's happening right now in Europe with recession, but the social head that you've seen during COVID. You've seen the difference in GDP growth between Germany and France, for instance, or Italy and Spain. So what we're trying to do is not to be dependent of any national economy.
What about you guys?
I think Warren Buffett was asked, how do you lose money? And he said, I'm paraphrasing, the 2 L's, liquor and leverage. So I think from our point of view and our experience, and if you look at the data, the size of the company per se does not drive the outcome. It's really the structure, how much leverage at the end of the day is one of the key points. So we like non-sponsor because we're much more aligned with the borrower. This is their crown jewel. They don't have 15 or 20 portfolio companies like the PE folks who should lever as much as they can. So in our view, an ounce of prevention worth a pound to cure. We start typically with 2 turns less debt to EBITDA, and so I think that builds in a big margin of safety and cushion for that inevitable rainy day.
I fully agree with that. I think that I would not say that small is beautiful. I would not say that the large segment is more attractive than the small segment. I think that the answer is in the hands of investors. It's a matter of diversification at the end of the day, and investors needs to be to have a presence in all of those segments. What we're doing is that we're specializing in a given segments because there are some specific features that we have to be familiar with, and at the level of our investors and LPs, this is the diversification game that will be the winning game.
I'm going to ask a question to my colleagues, or panelists rather. In terms of the online companies, right? So, we know that the demand for credit in the economy remains the same or grows with GDP roughly thereabouts a year. And, the banks have kind of pulled back because of regulatory reasons, right? They're not in the risk game anymore, so they kind of allow you guys to come in. But in terms of that going forward, how do you see the development of that, i.e. the demand for credit, i.e. the potential to find good deals? Because somebody has to pick up the bad deals, right? Somebody is doing that. Clearly not any of these three guys. But, how do you see kind of that, the opportunity set going forward in terms of the number of companies? Because there's only so many companies with the positive cash flow, with all the kind of right criteria that you kind of all look for in the kind of same segment of the market. So I'm just kind of curious, how do you see opportunities there?
So you all talking about? Oh, sorry.
I think the key point is you can't do everything. So, and I'm sure it's the same for the colleagues on the panel. We see over 1,000 things a year, and we do 2%. So I think on the one hand, the key is quality, not quantity. On the other hand, and I think this is true in Europe too, but in the US, the middle market is hundreds of thousands of companies. So there really are a lot to choose from. So if you have a very senior team that sees a lot each year, you can build a pretty good funnel that is pretty all-weather. Put aside now, we do think is a particularly good time, but even 2, 3, 4 years ago when it was very frothy, still seeing very high-quality companies that for any number of reasons would choose our solutions.
Thank you for that. So you all mentioned how to diversify, but and presumably investing in the right sectors. But first, I guess if everybody's chasing the same companies, we'll have a competition issue. And second, I was wondering whether now is the market ripe to go back to more cyclical sectors, and if not, when it's going to happen?
So first, the competition always existed. We started 22 years ago, and there were probably 5, 6 active private debt managers in Europe. So, but there were very few transactions. So we were competing among 6 people for 10, 15 deals a year. So today, it's hundreds deals a year. And we are probably 50, 60, 70 active private debt managers in Europe. So I think competition is not an issue because volume increased because of the disintermediation of banks and the fact that the private debt, the private sector took more market shares. And we're now in Europe, I think, at 65, 70% versus 80, 85 in the US. So you've got still some degree to increase our market share. Your second point on cyclical, it's an interesting one. I think we all do different things. You're an investor, you're doing a sub-debt for small companies, and you're in the US doing, we're doing private debt, mid-cap in Europe. I think it's all down to one thing. It's not one thing is better than another. It's one manager can be better than another. And in all those various segments, it's about the experience of those managers. If I had to say one thing to differentiate one manager from another is the experience. Have you experienced 2009? Have you experienced the recession? How did you manage to? That's how we're going to see. When things go well, things go well. You cannot differentiate a good and a bad manager when the stock exchange takes 10, 15% a year. And the same in private debt. Now we're going to see who's been swimming naked for the last 10 years. So hopefully that's going to help the job of LPs like you to to pick the right one, because although it might take 3 to 5 years to realize the losses or the default, you're still going to have a pretty decent shot at looking at their portfolio today and say, well, it's likely that those guys are going to default soon, if it's not the case. Going back to your cyclical thing, even in cyclical industry, we ourselves focus pretty much at 75-80% on healthcare and software for the last 15 years. Others do cyclical industries very well for a long time, and those guys will do very well for a long time. So I don't think it's pretty much impossible to time the market. I don't know if it's the right time to invest in cyclical industries. Maybe, if you're a good and experienced manager.
Greg, what do you think?
We're avoiding them. We generally avoid them, but in the U.S., with now mortgage rates over 6%, it's a very consumer-driven economy. You can look at other aspects of, student debt, credit card debt that are high. On the other hand, you have generally higher than usual consumer savings. So there's always a on the other hand, but generally it's a very high bar for anything cyclical in our pipeline.
Richard?
I would say it's true that not all sectors are created equal, but we do not have a sector focus or thinking. We're more driven by the business model of the companies, and the reason for that is that what we're doing is cash flow based mezzanine as opposed to value based mezzanine. That means that we do not rely that much on the value realization of a sale of a company 5 years down the road, but on the cash generation by the company and the way it will amortize its senior debt. By focusing on cash flow based, on cash flow generating companies, of course, there will be some business models and maybe some sectors in these current market conditions that we will avoid, but not because of a sector, just because the current market conditions are such that the cash generation is not guaranteed at a comfortable level.
So, do you want to add something on this?
I just mental image. There's a lot of GPs talking about swimming naked. That when you know in a certain environment, when you start talking about naked swimming, that's distressing me a little bit. To be honest, no comment.
Right. We only have a couple of minutes left. Just one quick question, and we can wrap that up. What about term sheets? Are you guys upgraded your term sheets? Are you much more expensive now because of the risk situation?
Can I just ask a question? Because I was going to ask about that in terms of fees. Do you see, which I guess was a little bit in line with you, but as an investor, do you see there's a fee, the costs in terms of how they develop going forward? In the same way that most other asset classes seem to be gradually declining fees, but do you see that?
We're not going to decrease our fees and our margins right now.
Of course
that's
not.
for sure. Now, we're going to try to increase the fees and margins. But the point is, in private debt, it's all about not losing money rather than increasing your margin. The cost of it sounds stupid, but it's mathematical, actually. When you lose the principal invested, it's much harder. So fundamental credit analysis remain the most important thing. Obviously, if you can increase your upfront fee, your margins, and especially your legal terms and the protections you can get from those agreements, it's much better. But the fees, yeah, it's going to increase, but there's a point at which if you increase too much, nothing's going to happen. So there's always an equilibrium, and at the end of the day, it's more important not to lose money than increasing your fees.
Well, when we're underwriting, we're really, besides picking a resilient business, thinking of the covenants, the leverage level at the borrower, and then the economics. And we actually focus more on the first two. So We focus on get as many covenants, set them as tight as we can. It's a little easier since March to do that. Set a appropriate, modest leverage. And then since March, we've added 100 basis points. So instead of L8, we've been getting L9 in our loans, and obviously floating rate.
Of course, the fees and the spreads have to be risk adjusted, and of course, in a risky environment, everything else equals, there will be an increase of those terms. However, at the same time, the structuration of the deals will change. There will be less leverage, maybe more protective covenant, and therefore, I don't know where the balance will end, but it's probably a second order effect rather than a first order effect.
Thank you, Thor.
I can't talk about management fees, to be honest with you.
I know. Have they answered your question as well?
No, really, it's okay. We run out of time. It's okay.
Well, I think that's all what we have time for, I'm afraid. So I'd like to thank our panelists and our audience for listening. Thank you very much.